All right, so Rick has a question about taxes and investments. My question is fairly straightforward. What are the tax implications of not reinvesting my annual capital gain distributions in my taxable mutual fund accounts? And by tax implications, I mean from both perspectives of the immediate tax impact of filing the 1040 every year to the long-term impact of creating any taxable nightmares. I completely understand the consequence of not reinvesting while one is building up your nest egg, but now that we're enjoying retirement, it appears to be a source of additional money that I'm already paying tax on every year. I just don't want to create an accounting tax nightmare. Let me let this guy out and we'll answer the question. Start with, you have $10,000. You invested $10,000 in Wellington. We'll just use that for an example. All right. Your cost basis is $10,000. All right. So that's how much you put in. That's how much you've already paid tax on. That's called the cost basis. All right, we're going to say there's a 10% capital gain distribution. That's $1,000. Hold on just a second. All right, so now let's say you reinvest that $1,000. All right, you reinvest this. Now we have $11,000, assuming the price hasn't changed. We have $11,000. So we start with $10,000 as our cost basis. We have a $1,000 capital gain, which we reinvested into the fund. So now our cost basis is $11,000. Why? Because we had to pay taxes on that $1,000 distribution. Regardless if we took it as income or if we reinvested in the portfolio, we had to pay taxes on it. As such, that increases our cost basis if we put it to the portfolio. Outside and watch these little rugrats here. All right, and it's 70 degrees here in Georgia. Woo, and February 25th is nice. All right, so again, we start with $10,000 in Wellington. All right, we have a $1,000 capital gain distribution, or it could be dividends, and frankly, it doesn't matter, it's not. And we're going to reinvest that. All right, so the very next day, essentially, our account is worth $11,000. $10,000 cost basis, $1,000 distribution. We're assuming the price hasn't changed just for simplicity here. All right, so we have $11,000 as our cost basis. We had to pay taxes on that $1,000 distribution. We did. Even if we reinvested it, we had to pay taxes. All right, so now we're going to say that $11,000 grows at 10%, all right, just on capital appreciation. So now that $11,000 has grown $1,100, and it's $12,100 is our value of the portfolio, all right? If we sell that, that is $1,100 that we have to pay long-term capital gain tax, assuming it is a long-term capital gain held for over a year. So again, start with 10, $1,000 distribution, 10% distribution. We reinvested it. That's at 11. We had 10% growth on the 11, so now it's worth $12,100. We sell the fund. We have a $1,100 long-term capital gain for which we have to pay tax on. All right. Now, the counter to that is you start with 10. You got that $1,000 dividend or long-term capital gain for which you sent to your checking account. So now your $10,000 portfolio is still $10,000. That $1,000 you received as a dividend or capital gain is sitting in your checking account. You still got to pay tax on it. You still got to pay tax. Now your cost basis on your mutual fund is what? Well, it's still $10,000, right? Because the price hasn't changed. So it was $10,000, received a 10% distribution. We sent it to a checking account. It's still $10,000 today. Now that still has gone 10% because the portfolio grew to 10%. So now was a cost basis of $10,000 is worth $11,000. 10% on a $10,000 is $1,000. That is the growth of the portfolio. So we have a $1,000 long-term capital gain if we were to sell that, if that makes sense. So whereas before we had an $1,100 capital gain because we reinvested dividends, that's the beauty of compounding interest. Now because we don't have compounding interest because we took the capital gain or dividends that we received initially and we put it in the bank account, we have the difference between the compounding on $10,000 or the compounding on $11,000. I hope that makes sense. Either way, it matters not from a tax perspective. Now, will it matter some from a income tax hassle later on down the road? Well, not really. The brokerage firms should be pretty adept at keeping track of your cost basis on each dividend that you reinvest. And frankly, they do nowadays. I think it was 2011 or 12 they had to fix that because before it was a nightmare. But now it's pretty good. So in this case, reinvesting dividends makes sense unless you want to live off the money. That's fine. But you're paying taxes on it either way. From an accounting perspective, it's literally no big deal. You're paying $1,000 of tax regardless of you reinvesting it or not. Will it be more of a hassle later on down the road if you reinvest it? I guess potentially if your brokerage firm doesn't keep records, but I think they have to nowadays. So anyway, hope this helps. I'd love to hear your guys' thoughts. Thanks now.